Our next speaker is Dr. Karl Hausker. He's a senior fellow at the World Resources Institute, their climate program. He leads analysis and modeling of climate mitigation, deep decarbonization, and the social cost of carbon and power sector policy. He's worked for more than 30 years in the fields of climate change, energy, and the environment, in a career that has spanned legislative and executive branches, research institutions, NGOs, and consulting. From 2007 to 2013, Karl was vice president of ICF International. He worked in India in 1999 as a visiting fellow. He worked for President Clinton as Deputy Assistant Administrator in EPA's Policy Office, and he represented EPA in various interagency fora and COP1. He also served as Chief Economist for the U.S. Senate Committee on Energy and Natural Resources when it was under profoundly different management. Karl.
Thanks, Michael. Yes, I've come a long way since working on the Hill in the late 80s and the early 90s when it still functioned to some extent. Really appreciate the chance to be here today and talk about the latest report by the Risky Business Project. Many of you probably are familiar with the Risky Business Project. In 2013 or 2014, it released its first report that was the most detailed, granular look at the physical impacts of climate change that were coming to the U.S. and a quantification of the economic impacts. Last year, late in December, they followed it up with a mitigation study, a look at what does it take to decarbonize the U.S. energy sector between now and 2050. And so both of these reports are available at the Risky Business website. I'm going to give you a very quick overview of this latest study on deep decarbonization. I urge you to go up on the website. We have a huge, wonderful amount of material and interactive graphics that go into much more depth than I possibly can today. I'll tell you the analytic approach we took. As Jeff said, this study is actually related to the Deep Decarbonization Pathways Project in the sense that it uses an updated version of the same model that was used in that round of studies several years ago. What we did was take the Pathways model and updated it with a new reference case, keying off of the EIA 2015 reference case, and also explored 4 different ways that we could decarbonize the energy sector. Just a couple of caveats. There's a lot of different kinds of models out there. This is sort of a pure technology pathways model that will tell you not only how to get to the goal, the emissions goal you want, but will give you the first order estimates of cost, changes in technology costs, capital costs, changes in fuel costs. It is not a full-blown economic model, so it doesn't project GDP and employment. Those are advantages of those types of models. One of the advantages of this type of model is a lot of granularity in how you meet specific end-use demands in the economy, different pathways you can take to get there, and a very careful look, particularly at the power sector, where you have to carefully balance load every day. And as you go into very heavy use of renewables, that task becomes more complicated. It's doable, but it becomes more complicated. The target we set for deep decarbonization was an 80% reduction in CO2 emissions from the energy sector. Of course, that's just part of the problem. And later, Judy is going to describe a study done by the Obama administration which looked at all 6 greenhouse gases. So be aware that we just looked at the main chunk, the CO2 from the energy sector. Second, we looked at how do we do this with existing or near commercial technologies. That's a constraint on the modeling. We did not assume that batteries could fly airplanes, which might happen in the future, but there's a conservatism here in looking at technologies that are near commercial or already commercial. We also used an assumption that we're going to allow capital stock to turn over naturally at the end of its lifetime. That keeps costs down, but that means you can't achieve emissions reductions as quickly. But going back to the 80% number, I want to key off something that Jeff highlighted too. 80% reduction was kind of the Obama soft long-term emissions target for many years, but we also know, based on the latest science and the discussions coming out of Paris, that is probably the minimum of what we have to do. We may need to go to 90-95% reduction on the path to ultimate full decarbonization of the economy. So in that sense, this analysis shows the minimum of what we may need to do. So, a snapshot of the results. Again, very interesting parallel to what Jeff said. There's really three basic tasks you have to do to decarbonize the economy. You need to switch as many end uses as possible from fossil fuels to direct use of electricity or the use of fuels derived from electricity, such as hydrogen or synthetic gas. Second, you have to, of course, if you're going to generate all electricity, decarbonize it. Third, across the whole economy, try to be as energy efficient as possible. These are the three pillars that pop up in any study of this nature. They're very, very consistent. I'm going to describe in a minute the four pathways we modeled, but just focus on one pathway, how we did that on the end-use switching. Right now we have about 23% of total end-use demand is met directly by electricity. In our pathways, we could more than double that to over 50%. The decarbonization of the power sector, we can go from over 500 kilograms CO2 per megawatt hour to take that down to almost zero. And finally, we can increase the energy efficiency of the economy by more than 2/3. What does that mean for the big picture primary energy use in our pathways? What this graph shows is the current fossil energy use in 2015 and where we think we can get it down to by 2050, and then what happens to your non-fossil energy use and your fuels derived from electricity like hydrogen. Currently, not surprisingly, you have big chunks of gas, oil, and coal, and at about 75 quads per year. In our sort of central tendency pathway, we call the mixed resources pathway, coal is almost eliminated. Petroleum goes way down and is largely used for, we're still flying airplanes and doing some heavy duty trucks with it. Natural gas continues to be a significant source both in industry and in burning gas with carbon capture in the power sector. And then kind of the flip side, we see our current use of uranium as a fuel and biofuels, solar and wind. All of those increase significantly by 2050. However, we get rid of ethanol, which is probably the worst fuel ever invented by humankind, and we have the use of biofuels. We have a fairly optimistic assumption about how much biomass is available to use, and that's something we could talk about during the discussion period. Here, I'm going to look at the power sector and the transport sector as the two most important sectors in terms of how we played with different pathways to get there. And I want to emphasize again, there's no silver bullet. There's no one way to get there. They're very important choices we have to make, both collectively and also driven by market forces and costs on how to get there. I'll describe the four pathways very briefly. We have a pathway in which we have relatively high use of carbon capture and sequestration on both gas and coal plants. We have a scenario in which we use relatively high, large expansion of nuclear energy. We have a pathway in the power sector with relatively high use of renewables, and then what we call the mixed resources pathway, which is kind of the most balanced blend of those three major categories. Each of these is coupled with a technology scenario for the transport sector, which we'll flip to in a minute. But with the high nuclear scenario, we run nuclear plants flat out, and in periods of low demand, we use that electricity to generate hydrogen. So we have a high use of hydrogen in the transport sector. in that pathway. In the high renewables pathway, we're using surplus peak power to recharge electric vehicles. And again, this is we need to figure out some way to balance our expanded power system and the patterns of generation with a transport system that has to rely on either electricity and or synthetic fuels. So when you look at this and we see here's a reference case forecast for 2050, the first thing you notice, of course, is you're generating a lot more power. That's that switching the fossil fuels to electricity, electric fuels, and the composition of the different power sources again varies and is dependent in part on what's happening in the transport sector. Just to give you a flavor of what's happening in the model, we model all 9 regions of the U.S. All this is up on the website in infinite detail. But interestingly, the model builds solar in the Southwest, it builds wind on the plains, it builds nuclear in the most regulatory friendly climate, so the South Atlantic, Southeast, lots of good granularity there. In the transport sector, here's our reference case dominated totally by petroleum with a little bit of ethanol up there. The first thing that strikes you about this chart is the transport sector has become much more efficient. That's that third pillar of decarbonization. You can reduce your quads by over 10 quads of energy use by being more efficient. And then you see mixtures of hydrogen and renewable diesel. You see a lot of electricity here with biogas. And again, these are coupled with what's happening in the electricity sector. What does this cost? I'm in total agreement with Jeff on this. This cost is manageable. It is not free, but nor is it going to be the end of Western civilization. This bar graph gives you decadal averages for the 2020s, the 2030s, the 2040s. What do we need to invest in clean energy in the blue, and what kind of fossil fuel savings are going to be racking up on an average decadal basis? We would need to invest about $200 billion above base case during the 2020s. That will grow to about $400 billion in the 2030s, ramp down to the mid-300s by the 2040s. And the fuel savings just grow exponentially. Not only the quantity of fuel is being saved, but also as fossil fuel prices tick upward over the next century, you get that double effect of price too. Is 200 billion, 400 billion a big number or a small number? One good way to put it in context is we currently have an economy of about $19 trillion, and it's going to keep chugging along unless President Trump totally tanks it, which he promises not to. We currently spend over $3 trillion on investment. Typically, we spend 15 to 20% of GDP on investment. So if you're spending over $3 trillion on investment anyway, and we need to increase to tackle the greatest environmental challenge we've ever faced, that's a small increase in investment as a percent of GDP. It's about 1% of total GDP. This is completely manageable. In the interest of time, I'm going to just flip through these charts. We took the decadal averages you just looked at and break them down by what are we investing in and what kind of fuel are we saving. The fuel savings are dominated by petroleum, not surprisingly, and we can also do that on an annualized basis. Let me just talk very quickly about the implementation challenges involved in this. It's technologically feasible. It's economically completely manageable in terms of cost. But there are implementation challenges. Some of those are very much of a political nature. Pick your favorite power source: nuclear, CCS, renewables, some of the above, all of the above. Whatever path we go forward, we have to build a lot of power plants. We have to build them at a rate 2 to 4 times higher than some of our highest historical rates. We have a large NIMBY problem in this country. Nobody wants to build anything anywhere near them. Similarly, we need to expand the transmission and distribution system to electrify the economy. It's very hard to build transmission lines. So particularly my message to the environmental community is if you're serious about addressing climate change, you have to reduce NIMBY in this country. And that goes for natural gas pipelines too. We got to build a lot of infrastructure, and we need to do it fast. Shift to electric vehicles or hydrogen vehicles creates some very interesting challenges. We need to think about how we charge them. Do we do them with fast chargers, slow chargers, workplace, home? Can we do battery swapping? That's something that we probably need to do some planning and collective decision making on, because it's very hard for that to be called out purely by market forces. Finally, utility business models need to change too. That's already underway, given some of the turmoil in the utility industry. But ultimately, this is a tremendous growth opportunity for utilities, for IPPs, for rooftop solar installers. This is a tremendous growth opportunity. The flip side of that, of course, is there are going to be disruptions in the oil sector, the coal sector. Gas will probably continue to be a transition fuel. And again, if we collectively choose to do this, we need to collectively provide job training, transition assistance to those communities that are affected. So thanks. I look forward to the discussion. And I'll turn it over to who's next?